Facts. He is an ex-student of IIM Ahmedabad, so welcome back. I hope you enjoyed this day. So he did his PhD from UC Berkeley in economics, and prior to joining Sussex, he worked at LSE, and then he has also worked in a string of agencies. So broadly, they are connected with UN, WHO, and World Bank. And so his research interest is mostly applied macroeconomics related to development economics, health policies, and public policy. So in this particular case, we will talk about title, state, and borrower reputation, which is an empirical paper taken data from United Kingdom. So which is basically at the intersection of a couple of topics, so development economics on one hand, then agency problems, applied macroeconomics, as well as it's also related to public policy. So I'm sure it would be a great enjoyable talk. So
thank you, Anindya. It's a pleasure to be back here. As he said, very long back I was on the other side of the table, and it's exciting to be back here. This is a preface to this paper. It's joint work with Andres Lieberman at NYU Stern and Daniel Paravisny at LSE. Both of them have already presented this paper earlier this year. This is the first time I'm presenting the paper, so I might be a bit rough around the edges. Feel free to interrupt me for questions. And just a quick heads up on the paper. This is about financial access, but not about financial access as is commonly thought of as in India, where it's about banking people who are not banked. This is about people in a developed setting, in this case the UK, who are banked but have managed to mess up their credit scores. So these folks have trouble accessing mainstream banks for finance, and the only recourse is friends, family, or really high cost loans. And this is about that market segment. Okay, so the motivation is you have a fairly large pool of borrowers who access high cost unsecured consumer credit. Credit cards is one example, bank overdrafts is another, and payday loans, which are huge in the States and also fairly big in the UK. Okay, so these are uncollateralized loans, short durations, small sums of money, very high interest rates, sometimes ranging up to 3,000, 4,000% annualized. These are important sources of short-term borrowing for consumption smoothing for constrained households. And the policy concern here has been that the high-cost credit market can lead, borrowing in this market can cause a lot of financial distress. So there's a bunch of papers here. Skiba, Tubakman, 2010. Peji was my classmate at Berkeley. She's now at Virginia. And then Gathergood, who is in the UK. And his paper, recent paper, is perhaps the most relevant paper because he uses a regression discontinuity design to look at the effect of borrowing in this market on household outcomes, credit scores, wealth. Even he has a survey of households and he measures the financial distress, anxiety, etc. Okay, so in general, these papers have concluded, not all of them, but most of them have concluded that borrowers suffer because of the burden of repaying high interest. So they borrow, they get trapped in a cycle of paying high interest, and they borrow then to just repay the interest, and that vicious debt cycle. So think about, in the Indian context, think about the avaricious money lender you see in the Bollywood movies. The difference though is that the money lender in the Indian context is a monopolist in a village typically, while in these settings, these markets are very competitive. There are lots of competing players. So it's not immediately obvious what the case for regulation is because there's no obvious market failure if you have competing lenders. You could argue competing lenders will weigh off the risk and return, and they will not be earning supernormal profits in a market like this. Okay, so that's not the case. However, the regulators are arguing that the borrowers are unable to process the cost of this borrowing carefully, and that is causing the distress you see in the marketplace. So the response has been a lot of regulation. So Colorado is one of the pioneers in the US states in regulating the payday loan market. And then the UK more recently, partly because of work by Gathergood, has capped the amount of repayment. So I think you cannot ask the household to repay more than 5% of its weekly income, no matter what loan product you offer the household. Because that's the state of play here. Okay, so this paper is different. So we started the paper thinking we'll also try to quantify the amount of financial distress. Let me give you a bit of a backdrop here. So about 2 years ago at Sussex, this entrepreneur, Frederick, showed up, and he's running this microcredit firm. He had worked in a big bank in New York and then London, and he had noticed that new migrants to the UK were cut out from the mainstream market because partly language barriers and partly because they arrived without any credit history. So these people were dependent on family and friends to borrow when they needed money, and then they would go to payday lenders and these high street shops, these kinds of firms, to borrow money. And he started a business focused on lending to these guys. So he came to gave a seminar. I talked to him afterwards, and we decided to work with him to study this problem a little more. So he's the one who gave us all the data that we've used in the paper, and I'll talk more about the institutional setting and the firm as we go along. But we started the project trying to see whether there was indeed financial distress. In fact, he argued that his firm was a bridge to mainstream finance. So you have a new migrant who comes in, he has no credit history, he maybe opens a plumbing business, hires or buys a second-hand van, the van breaks down, he doesn't have the money to repair it, so he needs to go to these kinds of people to borrow the money and get to work, and that is a useful social service that this sector is providing. So his argument was, can you find for me sub-segments of the market where you think we're actually helping people and not just trapping them in this debt cycle? That was the argument. So we started looking for that, and we also were trying to see if there's indeed financial distress. And then as I go along, you'll see the Stylized Facts suggests a very different story. It's a more complex story. It's not necessarily opposing the burden of debt repayment per se, but we don't find much evidence that there is actually a very high burden of debt repayment. There's in fact a reputational story here. So basically the argument is that if the average guy who approaches these guys and takes a loan from these kinds of lenders has a high probability of default, then the market, when it learns this, the lending market is going to tag these people as risky, so they're stigmatized. Okay? So there's a reputational hit from borrowing from these people, and when this hit becomes public, right, the other lenders are going to update their repayment risk, and so there's going to be this tightening of the market around this borrower. Even without having to struggle with repayment, he's now struggling to find additional finance because he's been tagged as a high-risk borrower. So this reputational channel that comes through very clearly in this paper. And this is a very nice paper by Manso, I think Journal of Financial Economics, who looks at this problem in the context of bond issues by firms in the run-up to the financial crisis. And he argues that when an agency like Moody's or S&P rate an issuer, they usually look at the credit worthiness or the paying capacity of the issuer. Going forward, what they forget is that if in response to a small shock to fundamentals, they downgrade the issuer, that automatically triggers a new dynamic. It means the market tightens around the issuer, and that means in response to small shocks to fundamentals, you have this downward spiral. Multiple equilibria are possible. And this is a similar idea is there in our paper right now. Okay, so because I often don't get through all the slides, it's great to lay out the paper in short and the findings before I jump into the methods. So we are able to track the full repayment and credit history of all applicants to a high-cost lender in the UK over a 3-year period. We try to pin down the causal effect of receiving a high-cost loan using 2 alternative empirical strategies. First, we exploit the fact that there is implicit random assignment of applicants to different loan officers with a differential natural propensity to approve loans. So some officers are more lenient than others. So given the same applicant with the same observables and the same information, on the margin, I may be more likely to approve than, say, somebody else, and that is what we're going to exploit, and I'll tell you how we construct that instrument. So that's the first strategy, and when you use that, this is the set of facts you find. One, receiving a high-cost loan causes an immediate negative and lasting impact on borrower credit scores. So right away, a person who borrows from this, and this is a causal effect, it's not a correlation, I'll show that to you, sees a drop in his credit score, and that's persistent, stays for 12 months. Okay? This person is going to be taking on more credit, and this is entirely driven by more short-term credit because it actually borrowed from this guy, and that's the expansion in the credit of this person. This person shows a higher default rate about a year later, and there is evidence that there's more search for credit by this person, but not additional credit except for what's coming from this loan. So this guy's looking at other lenders and they're not lending to him. So he is rationed. He's being shut out of the market. The market is tightening around him. So this is coming through from this, the first instrumental approach. We also use the regression discontinuity design, which I'm assuming most of you are familiar with. It's now popular in empirical work. It's a fuzzy design because it's not a sharp treatment. And here, this design is valid for the sample of borrowers at the lower end. So the setting is that you show up and your credit score is pulled. And if your credit score is very low, below 400, the lender will not lend. So you're really the worst of the worst. The people are coming are already constrained, but at 400, you're worst of the worst. So those of you who've stayed in the States or the UK would know that if your credit score is good, it's a scale of 800, you would have a credit score of around 700, 750. Okay? Below 650, you start to enter the subprime segment. Okay? You start to pay higher interest rates. You're turned down by mainstream borrowers. The average guy here has a credit score of 550. So they're really a bad pool, a risky pool. And below 400, you're pretty much at the extreme left tail of the distribution. Even these guys won't lend to you. Even at the high interest rates, it won't lend to you. So we use the fact that there's a 400 point credit score threshold cutoff, and it's an RE design, so we can look at people around the threshold. And for this pool of the riskiest borrowers, we find there's no effect on credit scores. So there's an effect on the average borrower, but not at the lower end, at the left tail. Okay? And our interpretation of this is that these guys are already known to the market as the worst of the worst. So there's no reputation to be lost because they don't have a reputation to begin with at this point. They are already considered as very high-risk borrowers. So any effect on them from the loan should be on from the repayment, burden of repayment. But we actually find that after a year, there's no change in default rate, and there's no additional search for credit. So there is no support in this paper for the repayment story. It doesn't seem that that's a big driver of distress. Distress seems to be happening for the average borrower. The guys the market is a bit uncertain about. The priors are, okay, this guy's at 550, 560. He's starting to look risky. Then he goes to this firm. This firm is a high-cost lender. It reveals something about this guy's type. So we're going to stop lending to him as a mainstream lender. That's the story here. And I'm going to show you evidence for that. Any questions so far? This is the outline in some sense. Yeah?
So the data is from one firm. This. So we have any selection bias is that or not?
It's internally valid. I don't know whether it's their pool of customers is very different from, say, Wonga or the other firms, because we don't have their pool. I'll show you the statistics of the applicants, and you can see.
So, another question. So, do you restrict the sample to the ones that are above the threshold?
So, for the first approach, which is the instrumental variable, using the leniency of the loan officers, we don't restrict the sample. For the second approach, it's an RD, so we look at narrow windows, bandwidths around the 400 thing. So, okay. So, to wrap up the story, and then we can get into the gory details, the results are most consistent. Our results are most consistent with an interesting information story that high-cost borrowing signals high risk to credit markets, which tightens future credit constraints, which in turn leads to this downward spiral of worsening financial health. Individuals with a very low credit score, the worst of the worst, have already paid their reputational cost. They have no reputation to lose. And in particular, the results are difficult to reconcile with the burden of repayment story, which is the popular story in policy and academia, which is that there is no reason to expect burden of repayment to be lower for people who have the worst credit scores. If it is a burden of repayment story, we would have expected to see financial distress even for the worst borrowers. We don't really see that. This is not a clinching argument. The important thing is the reputational channel is the one we've uncovered in the paper.
That's what.
So what you argue is that people who were slightly above the threshold are the ones that are affected.
So people, it's an average. So when we do the first one, we take the average across. When you say slightly above, we should think of people in the 500 to 580 range.
So did these people have other options, or were these borrowers the only options they had?
So we do not directly observe what they do, but we have access to the credit files on a quarterly basis, so we can see changes in their credit status. So if they open additional accounts, we can see that. If they searched for more credit, we can see that. So they do have options because we see them searching for more credit. We don't see them getting more credit. So they are being rationed after they have borrowed from us.
But after the borrowing, but prior to their borrowing, what do we know about the institutional structure so that whether or not these people have access to it? And so therefore, if they are in fact coming here, why are these select group of people coming here and not going to us?
So I'll show you a graph in a second. It's like an event study graph. It's not causal, but you'll see they're coming here. Prior to coming here, because we took snapshots of the credit history before the date of application precisely for that question, you see sharp drops. These guys are suffering something, some financial, some personal situation, a job loss, illness, some other situation is causing them to start to see it. So you see declining credit scores before. You can see very clear. And they may be looking for credit, but clearly when you come to this point, you have been shut out by the Barclays and the HSBCs and the big banks. Your credit cards are maxed out or something because you would not borrow at this rate if you could use your credit card, for instance.
And so and your performance with these borrowers sort of gets reflected in your credit score in the future also?
Yes. So the borrower we are talking about feeds information on repayment and borrowing on a continuous, as an i.e. weekly basis, to the agency, credit agency we use. So it's very fairly real time. Okay. So some stylized facts from the data. Then the two empirical approaches, loan officer leniency and then the regression discounting design. And then I'll wrap up. I probably will speed up through some of the slides because I think I'm not able to get through this one. So the stylized facts. So it's not as if, so it's fairly, in terms of this market, as I said, the existing literature is focused largely on the burden of repayment story. So in that sense, I think the reputational channel is a novelty of this paper in this setting. But if you look around, you can see the market has been picking up on this for a while. So I don't want to claim Investopedia is a kind of reference you want to put out, but you can see that you have statements out there suggesting people are wary of folks who borrow from these kinds of lenders. So demographic groups that take out payday loans tend to have higher default rates. And some lenders might see the fact that you've taken out a payday loan as a sign that your finances are under pressure, which is this flagging that happens. And mortgage industry polls have suggested that up to 45% of brokers in the UK have had a client application rejected because of a prior payday loan. So as soon as you take out a payday loan, you're flagged. And we're seeing that in the data very. So in fact, when we reported these findings initially to the lender, they were quite upset because they could see that their clients were getting flagged right away, which meant their clients were getting hurt in the medium to long run. Okay, so this is the graph I was talking about. So you can see here, this is just an event study kind of graph. There's nothing causal here. It's a before after. The dashed line are people who so both are groups who approach the lender for a loan, the high cost lender for a loan. The dashed line is the group that's successful. It gets a loan, hence take up. The solid line is the group that's rejected, no take up. So you can clearly see that people who are slightly better are more likely to get the loan because the average is higher for the take-up group. You can see that prior, this is quarters on the horizontal axis, and 0, it's centered in the quarter of application when you apply for the loan. So you can see prior to the quarter or 2 quarters before coming to the lender, you're starting to suffer. These guys are getting into some kind of crisis. Otherwise, they wouldn't show up at the doorstep. That's why they're showing up, because they're in some kind of crisis. And then you see that there's a sharp hit right away. You can see the dashed line dropping. When you take up the loan, and it persists, flattens out, and about 4 quarters out, you're no different from people who have not taken the loan. So you're seeing that huge drop, and I mean, we're going to tease out the causal bits of this because for these guys are obviously apples and oranges. People who got the loans, you can see right away that the people who got the loans are different because they had a higher credit score to begin with. So we're going to, the rest of the paper, in some sense, is teasing out the causal effects.
One question. So solid line. People who applied for the loan but didn't get it as payday loan, right? So they should be the worst credit risks. So their credit, their rating should suffer more, right? Rather than less.
So in what sense? In some sense, they're already worse credit risks. They did not get the loan, so the credit file didn't expand. So the guys who got flagged with the dashed lines, they now have on their credit file a flag saying you borrowed from this guy, and They have been dinged. So somehow the market is interpreting it as you're going to default in the future. What the market is doing is it's predicting that, it's tightening around them right away. It's causing that spiral which I talked about.
But in the no take-up line, so there's no information that this guy was rejected for a trade loan, right? In the credit file?
No, but there was no information that, no, there is information in the credit search, but it doesn't show up as a successful loan. So yeah, that is, yeah. Okay. So let me, we wanted to kind of poke at this repayment idea a little more carefully. So we took the people who got the loan and we broke them into 3 groups. The first group is the group that defaulted right away. So these guys typically get a loan of £200. They got the loan and they walked out. Okay, the guy who runs this business gave me an interesting story. The first gentleman who borrowed from him was from his part of, it's, I think, Congo in Africa. He showed up in a dapper white suit with a walking stick and a hat. At that time, he got a £1,000 loan. He was never seen again. He disappeared. £1,000. Okay, so these are guys who show up, they're strategic defaulters, they will default right away. Why pay if you're going to default? Why won't pay back £10? So you can see that they do indeed take the worst hit because right away the lender reports to the credit agency that these guys have defaulted even on the first repayment. Right? So right away you can see they do take a hit. The second line is people who default but default in part. They pay back some but not all of it, and you can see they too take a hit but not as big as this. And the third line is people who pay back in full. In all 3 cases though, after a year, they have roughly the same credit standing. So that is interesting. So the dynamics of this is something we don't fully understand. That is a very good question. Daniel and I talked a lot about this as to why you see this happening, as to why it's happening. But the scale is a bit misleading in the sense that this is the average drop we are picking up, because this is the drop for the successful borrowers. So these guys have a bigger drop in the beginning and then they bounce back. It's not clear how, but this dynamic is something we're working on to unpack. It's true. Yeah. But the point I think we wanted to make from this graph was that if it was a burden of repayment story, you would expect this to kind of flatten out here, this to flatten out here, and this to stay here, but they all bounce back to the same thing. So there's a reputational channel that's very important, that's hitting all 3.
So when looking at this graph, if I am a borrower, I would rather default on everything because I know that within 1 year I think I will go back. So
except that you don't know this happens, but yes. You may do if you have done this enough, but of course the market may shut you out completely by then. Yeah. The other thing is that some of these guys come back for multiple loans, and so we looked at the drop in credit scores by the sequence, the chronology of the loan. So the first loan from such a lender, this lender, you have the biggest hit. Subsequent loans you have less hits. Both, I think, point to the fact that it's the very act of getting a loan from this lender that's hitting your reputation and your credit score. It's not so much the burden of repayment, because if it is the burden of repayment, why would it be the hit be the highest for the first loan and not for subsequent loans? Okay. Now this is all suggestive. So this is Stylized Facts we pulled out of here, because as we presented the results, the burden of repayment story keeps coming up, and we've been trying to figure out ways to deal with that. Because it's one of the dominant themes in this literature that people borrow just to pay back old loans, and that it means they're caught in a cycle where the lender is extracting high interest rates over time. Yeah?
Just to be clear, are these the drops due to the first, second, third loan and so on, or are these can't be the cumulative loans?
No. First, second, third loan. Yes. Because cumulative would just add up. Yeah, correct. Okay, so the points here summarize the graphs I just showed you, that the average perceived quality of borrowers that take up a high cost loan is the same a year later, regardless of their repayment history to this lender. So the burden of repayment story is not coming out critically, at least in the 1 year period. The second is that there's a large immediate score drop at the first loan and smaller drops at subsequent loans. And then the 2 questions we want to ask now is, what is persistent about the relationship between take-up and your creditworthiness as proxied by your credit score that is independent of repayment, right here? And why does perceived creditworthiness decline more with the first loan than with the subsequent loans? Okay, these are the 2 facts you want to explore. Okay, so some institutional background. I've already given you some of the lender. So it's a for-profit group, operates in England, mostly London, has moved to the Midlands, which is north of London, Birmingham, etc. It's 24 retail stores staffed by loan officers. Their USP, unique selling point, is that they cater, about half their clients are migrants. So they have a demographic marketing, many of you probably know marketing quite well. They have names, Stacy and Marek. Marek is the Polish plumber, the new migrant, no credit history. He's a great client to have. And Stacy is your stay-at-home mom who picks up a welfare check every 2 weeks. She also has gone through her credit cards, has no credit history worth speaking, no credit score that can get her access to finance. And these two are profitable client groups for this company. So they try to match the officers in the branch to the local demographic composition. So they're usually in the high migrant areas. So they will, if there are African migrants, they'll have African advisors, Russian migrants, Russian advisors, South Asian migrants, South Asian advisors, because they believe that language is kind of critical to build a banking relationship. The loans are unsecured, short-term, high cost, 600% is the median API, okay? Fixed installment, and there's often top-up offered after 1 month. So you have the option of topping up after 1 month. Repayment is, I said, weekly, and is reported to credit bureaus continuously. The approval process, the way this works is the loan officer observes snapshots of the applicant's full credit history in real time. So he pulls up the credit file when the guy is sitting in front of him. Then he interviews the applicant and obtains additional information, employment status, wage, debt income, the standard stuff a loan officer will look for, and then decides to approve or reject the application. Okay? So that's how it works.
Yes, again, if I have a repayment schedule weekly, and if I see that is not getting reflected in credit score, which is clear from the chart to the top, I'm not exactly getting how that can happen. So suppose if you have an installment schedule which is going to whatever clearly, that may happen. But if you have a weekly installment.
So what happens with the dark line? Remember, the dark line is the one that's confusing, and really it is a good point, because so the hit is because the fellow has disappeared. He actually disappears. He is not paying a single installment. So in the first 2-3 weeks, the firm realizes the guy is gone. So that's why the hit happens in the first quarter. Why it bounces back is the question. That is a good question. That is a good question. That is a good question. And because what it means is that how are they able to rebuild their credit history over the next 3 or 4 quarters, right? So it may be, and we haven't done this. I mean, if you look at this, guys, I don't know if it was the log score. So those differences are actually a little compressed. So these guys already in the subprime area. So I mean, it's probably not that different when they start off. Although at the point of application, you can see that these guys are starting to look bad. So it may be that these guys are already at the bottom, and so the reputational hit for them, it's all about if they behave, they're able to bounce back. The point is that everybody seems to be suffering at least that reputational hit.
So is it possible that these people who are defaulting completely, they arrive at some settlement and that allows them to get their score?
That is possible. They do. They will probably face what's called a county court judgment. So I don't know if this particular lender goes to court. I mean, they have a model in which they expect some default, and that's compensated, subsidized by very high interest payments. But I don't know if I think the CCG actually counts against you. So it must be that, so here's a fact that's not in the paper. A lot of the people who are borrowing and many of these default are doing so to be able to pay their cell phone bill. There's nothing quite as bad as losing your cell phone. So you need to stay connected. Personal reasons or work reasons, you need to stay connected. So it may be that they figure they're not going to come back to this guy again because this firm won't lend to them again. But we borrow from them, use it for whatever short-term shock, and then we are behaving reasonably okay with the other lenders. That's one story.
Yeah, if the firm is writing off the loan, then that could account for common credit.
Just one question on the graph. So is it possible that when the person is again asking for a loan, that is when the reputation, the score goes down? So in this case, these people who disappear do not ask for another loan.
They won't come to this particular firm. We don't know for sure what kind of other lenders they're going for. We see the broad categories, but we don't know for sure what kind of other lenders they're going for. It may be that among this group, it's an average, right? Among this group, there's a chunk of people who need money, who borrowed knowing they would default because they don't want to touch this lender again, covered that whatever short-term shock they had, and then behaved as the other risky borrowers do on other fronts, and that's why you have the rebuild. That's one of the things Daniel and I discussed as well.
What are the factors that determine credit score, major factors?
So you want to be using credit, and you want to be paying on a regular basis. If you're not using credit, your credit score is not necessarily very high. It's hard to judge your ability to manage credit. So all kinds of things go in, how many lines of credit are open, so, right? How many credit searches you do. Each time you do a credit search, you could, there are soft and hard credit searches. I can talk about this, it's a bit of an institutional question, I can talk to you later. But you'll be amazed at the amount of information the credit agencies gather in these settings. Incredible. And you are well advised to keep an eye on your credit score just as an individual on a regular basis, because if, for instance, there was a bill that was unpaid because it never reached you, you are in default, and it hits your credit score, and you wouldn't know of it, right? So, okay. So the average effect, this is the first of the empirical strategies, is loan officer leniency. So, okay, so I think I went through this. Here's a quick snapshot. I only want to point out a few things here. Notice that approval is about 76% of all applicants. Take-up is pretty high. Of those approved, about 85% take up the loan. More females than males. This is what I said, 43% are foreign nationals. So this is, 57% are UK nationals, and the country, the demographic split is more 90-10. In fact, maybe London is more 70-30, but this is still a firm that focuses on migrants. Salaries are low, but that's because lots of zeros. So the median salary is £1,000 conditional on having a salary. This is a lot of people don't have a salary. They pick up welfare checks and stuff, and they're banked. 91% have bank accounts, and they have many open accounts. These are credit lines for debit cards, and the credit score is pretty low on average, 540. Okay. They have formal access, but they may have maxed out their credit cards. Certainly, they may be banking with Barclays, but Barclays is not going to lend them any more money. They will not increase the credit limit, refuse a loan.
At the beginning, you gave example of high credit score, that I agree that there is competitiveness in that market. But for this specialized class of borrowers, is it a competitive market? Do you think that there is there is some type of selection bias?
So I don't think that it's a monopoly, to be honest, because when I talked to the firm, they mentioned a list of competitors, online other competitors. It's certainly not anything like your money lender in Indian village. That is not the situation. Either you borrow from him or you starve. That's not the situation. There are alternatives. It might be a restricted set, so this raises the question as to if the market is competitive, are these guys really being harmed? Because firms should compete, as I said, to any supernormal profit should be competed away. So in that sense, you should see a fair risk-return kind of product in the market. However, if these people have some kind of behavioral biases, myopia, time inconsistency, again, it's not immediately obvious what happens to those biases in a competitive market. There's these papers on shrouded attributes. If you have a single firm, a monopoly, and it's aware of behavioral biases among consumers, the monopoly can extract additional profits using those behavioral biases. But if you have a competitive market, it's not obvious that the behavioral biases necessarily hurt you to the extent there's competition among firms. That being said, there's work which shows that in oligopolies, firms can exploit behavioral biases, and that hurts consumers. Okay. The loans, so as I said, this group got the loans. These are the people who actually took the loans. The median interest rate is about 600%. The maturity is 6 months, weekly payments. The median amount is £200. This is the bread and butter product. Very small amount, £200 is what you get, and you pay back every week. And very high probability of top up, and obviously high default.
So you mentioned that stay-at-home homeworks, who are in charge of borrowers of these kind of loans, how do they expect to pay that this kind of interest?
Welfare checks. So the story they gave us was, they ask for why people have come for loans. Classic stories are like, I want to buy a Christmas gift because there's a sale on and I have a child, and the sale is on in late November, early December. Or my washing machine broke down, I need to get repaired. I've used up my welfare check, I have no savings, so I'll pay you back from there. So these are consumption shocks, unexpected events. So they basically pay them from welfare checks. And this is a tricky game for them. For defaulting for these moms is going to be costly because they're going to be shut out of the 1 or 2 lenders now left who lend to them. So it is that kind of a relationship.
The fact that their credit scores are going back up after default means that they don't actually suffer.
Yes, so if they know that. But it's not clear who knows this and who doesn't. And I'm not sure this is what we see in the data. I don't know how much public this knowledge is. You're right. If I default without knowing what happens, and then I observe after a few months, it goes up, it goes down and goes up, but it's still down. It's still down over thing. And I don't know if I actually know my credit score. I will probably observe it. I may not even know it for 2 years because it's in front of the loan officer, right? He's pulling it up. I don't know how much these people understand this thing. They know they're being blocked. They know the score is low, but I don't know how frequently they check the credit score. Right?
As the interest rates are sort of variable, you could see the borrower and then decide how much you can.
So no, in general, no. The reason that is like that is because there are multiple loan amounts and some, so this is, I said, by far the biggest product, but there are other loan amounts, and part of the reason is, these are all first-time borrowers, I should say that, but they have offered £500 and that's a different interest rate. So that's why you're, yeah, there is a different interest rate. And there are some different maturities as well. But this is the product you want to keep in mind for concreteness sake. This is by far the biggest. Okay. Okay, the standard omitted variable, the endogeneity problem, if you could find randomization in loan take-up, you could run this equation, a bunch of controls, your take-up variable, and you find the causal effect. Beta is the causal effect of getting a loan from this lender on various outcomes, and the one you want to think of is credit score, for instance. Y is the credit score. So take-up is the dummy that equals 1 if the application ends in a new loan. It's quite likely, and obviously this is the issue in omitted variable bias, that take-up is correlated with the error term. And so, for instance, it's possible that applicants with a higher expected income growth will have higher probability of approval and more access to credit. So that's going to mean that you have bias in your beta estimate. So we need an instrument for take-up. Okay, so the way we identify, that is the way we pin down the causal beta, is we use the fact that on a given date and a given branch, when applicants arrive, they are randomly assigned to advisors of their nationality. So it's basically a queue. When you arrive, you wait. If you're Polish and the one Polish advisor or two Polish advisors are busy, you're going to wait till your turn comes and you go. Okay, so you're not that we understand and we've seen that flow in the branches. Now, loan officers will vary in their natural propensity to approve a loan. I think I mentioned this before. Some are more lenient, some are hard, tough, right? So if the same person is seen, and this doesn't happen in reality, but the idea, thought experiment, the same person seen by two different guys, he may get approved by one guy and dinged by the other guy, given the same set of information. Okay, so we're going to use these loan officer fixed effects, which is what we're going to try to construct to, as instruments for loan take-up. We don't want to include the own observation to construct this leniency measure because it's going to be biased. So if somebody is approved, that makes that loan officer look lenient. So we're going to drop that particular borrower, and we're going to construct the instrument using the other borrowers. So I'll show you the formula, and it actually looks a little gory, but it's actually quite straightforward. The intuition is very straightforward. So, and this is not a new instrument, so it's not ours. It's been out recent, 2008, started by Chang and Shor, and not Shor, and the most relevant paper is Dobby and Song 2015. Many of these are like AERs, and so this instrument has been finding acceptance. Okay, and we are going to condition all our regressions on branch by week of application by nationality fixed effects. So we're basically looking within these cells. Given branch, given week, nationality, we believe that there's random assignment of applicants to loan officers within those cells. Okay, that's what we're going to do. Okay, so this is the instrument, and basically the instrument is defined Z. This measure is defined for each applicant assigned to loan officer J at branch S on month M. So as I said, these cells are important, but these are now, we do it at the monthly level because we need to get enough size to construct this instrument. So this bit here is the average approval rate at that branch in that month, this bit here. It's not specific to a loan officer, it's the average approval rate at that branch in that month, dropping that particular borrower. So NST is the number of applicants at branch S or store S in month T, -1 because you dropped that particular borrower. So this is simply a measure of the average propensity to approve in a given store in a given month. This is at the advisor level. It's the propensity of the advisor to approve in that store, advisor in that store to approve in that given month. So basically this is normalizing everything to 0. If some officers are lenient by construction, others look tough. That's what this normalization measure does. Okay? So this Z, if I didn't have this, would be not normalized around 0. By doing this, I normalize it around 0. So anything above 0 is a lenient officer. Anything below 0 is a relatively strict officer. That's the measure we're constructing. It's a simple algebraic construction. Okay? And again, it's not new. It's been used in bankruptcy, looking at the effects of bankruptcy, because cases to bankruptcy judges are also randomly assigned in the doc. So this is what the measure is. So the intuition here for applicant I, ZI measures the fraction of all other applications approved by advisor J in branch S and month T relative to the fraction of all other applications approved by all advisors in that branch in that month T. Okay, so the second bit is just normalizing so that everything is centered around 0. Okay, so what are we picking up? We are picking up, you want to, yeah?
The instrument measure doesn't condition in any way the country of origin, because you say that there's a matching going on.
Yes.
So there are these systematic differences by country of origin.
Yes, that's why we condition on, in the regressions, we condition on branch, week, and nationality effects.
But I'm saying in the instrument to look at the leniency or sort of strictness, wouldn't I want to incorporate that?
No.
Because I may be giving out more loans because the country that I sort of deal with.
That may be fine, because you, as a, if you're Indian and I, you will only be seeing Indian applicants in general. So it may be that you are on average, as an Indian, more lenient. That is fine.
But I'm more lenient, say, compared to the Polish guys, and because I believe Indians are better.
Correct.
So then don't I mean, look different?
So when you in the regression, when you control for those cells, doesn't that take care of the problem? We can talk about this. I think it does. Let me think about this here. We are conditioning out nationality times store times week, and we are just looking at this measure. Okay.
Just one clarification. So there is no way one Polish guy will be matched with an Indian guy. No way.
If it does, I don't think it's a problem. It's rare, but if it does, it's not a problem, because we are picking up something that's so if you look at the formula, we are picking up something that's intrinsic to the thing.
But in that case, that matching problem will be there.
Why? Because he may treat, but it has to be very systematic in some way to cause the problem, right?
Yeah. So maybe Indians are just bad people who say that Indians are dumb. They will definitely treat Polish people worse than Polish people will treat Indians.
But to the extent that there is random assignment conditional on your nationality, does it matter? If you're, most of the time you're assigned to your nationality, sometimes you're not, but to the extent that conditional on your nationality arrival, you're put in a box, think of it, thought experiment. This is your nationality, this is your branch, this is your week, your date fixed, your branch fixed, and now the Indians are here, Poles are here. There's going to be random assignment from these to these officers. Is that a problem? I don't think it is. Because the leniency measure is picking up something intrinsic to the officer in some sense. Okay? So the graph, for instance, I'm going to show you now is showing that if it's something that's a natural trait among loan advisors, it should persist over time. So here we have leniency year t minus 1. So we do this, we construct this measure, it's at the borrower level. Then for each officer, we take all the borrowers and we average the measure for that officer and for the whole year. And this is year t minus 1, year t, and we should be seeing that people who were lenient last year should also be lenient this year if you're picking up something sensible about them. If you're not, it is just some kind of artificial construct, and this is a t stat of 6. It's pretty good thing. This is kind of a standard, again, not our standard chart in this instrument, this particular IV literature. It's certainly an interesting instrument to explore. I mean, this is the first time I've used it, and I think it's a nice instrument. Okay. So I'm going to, so I have to maybe, I'll go to the RD very quickly. I just want to show you that it's a valid instrument. So first stage exclusion and monotonicity, the standard exclusion of course cannot be tested formally. So I'm just going to show you evidence, but I'll show you the first stage. The first stage is pretty strong. It's a t-stat of about 7. And this is take up on advisor leniency. So we construct the leniency measure, and then we regressed take up on the leniency measure, conditioning on these effects, fixed effects I was talking about, store, week, and nationality fixed effects, country fixed effects, and you can see there's a clear first stage. It's a very powerful first stage. It passes the first stage tests well. Okay, so that's one. The exclusion restriction we cannot check directly, but I'm going to show you suggestive evidence that what you don't want is that the leniency, that there's non-random sorting of the borrowers once you have condition on these fixed effects I'm talking about. If there's random sorting, then it means that whether a guy is lenient, officer is lenient or not, who he gets the observables look very similar across different leniencies measures. If there's random sorting, so we regressed the leniency measure on the fixed effects, and then we regress them on the x's, which are the observables, and you should expect to see nothing. In fact, there's only one significant coefficient, that's male, and that's also at the 10% level. And in any way, when you have like 8, is it 8? Yeah, 8 variables, you probably expect to see 1 or 2 significant ones. The joint F test is insignificant. So in other words, on observables, you don't tend to see any sense of non-random sorting. It seems no matter what your leniency, you're getting the same observable type of borrower. So this hopefully addresses part of your.
Except when the loan officer's country of origin was there, then this is probably
So I have
actually looked at that as an observable also, right?
I see. So we, yes, but I mean, you see this here. Yes, so I should use a binary measure maybe. That's a good idea. That's a good idea. Yeah. It would be nice to see that. We will add that to the thing. That's a good idea. Okay, the other exclusion restriction is that the leniency, so actually, do I have till 5:10 or do I have to shut at 5 or something? Oh, good. I don't have to rush. Okay, very good. So the other way, the exclusion restriction, which is the idea that the instrument affects the outcome of interest only through the endogenous variable and not through anything else, no error term, is if the lenient loan officers can affect borrower behavior. Now, that's a problem. If there's something about the lenient loan officers that affects the borrower behavior independently of loan take-up, that's a problem. And so here's some stuff, institutional context. Loan officers are forbidden by law to advise borrowers. Okay? There's only one interaction at application. Repayment and top-ups are done electronically. And we are also measuring outcomes well beyond when the loan has matured. So if you have some sense of, I feel obligated to this guy, or I formed a bond with this guy, or this guy advised me on something, and that changed my behavior independently of the loan take-up, there doesn't seem to be a setup for that. I mean, again, it's not. Okay, but you can never test exclusion restrictions formally, so we're doing what we can, but exclusion restrictions are always a leap of faith in any instrumental IB regression. Okay, also, if the take-up decision is endogenous, so we're not looking at approval, we're looking at take-up. So you took a loan. Not everybody who got a loan takes a loan. About 85-90% do it. But we find that if we use loan approval as the endogenous variable, our estimates, which I intend to treat now, not actual treatment, are almost identical. And it means that the compliers, the additional approvals to the instrument, always lead to take-up. The compliers are generally complying almost 100%. When you have this, that the ITT estimate is the same as the ATE in IV estimate, it means the compliers are basically 100%. Okay, so now the final bit is from the potential outcomes framework. So you want the instrument to have this property of monotonicity, which is that it shouldn't be that some groups of borrowers are less likely to take up a loan when assigned to a more lenient officer. In that case, the IV is not valid. You're not going to recover the local average treatment effect. So here it's important what is leniency. If it's these behavioral traits on part of the officer, over-optimism, altruism, risk-loving behavior, it's not a problem. This is the kind of random variation across loan officers wish to exploit, because you're trying to create this quasi-experimental variation in take-up. If it's ability, it's a problem. So the idea of ability is as follows. If I am new or I am not good at my work, and I'm being judged mostly by the repayment behavior, my strategy will be to approve the really good guys and on the margin say no each time because it's risky. If on the other hand I'm good, I will approve the good guys, and on the margin I can separate the bad guys and the good guys better. So then I will also approve on some of the marginal cases. I look lenient, but that's reflecting ability. And that's a problem because the good guys repay and their credit scores don't get hurt. So that's a problem if that kind of ability story happens. So here we have plotted, and this is very tiny, the vertical axis against the advisor leniency measure. We have a scatter plot of the relationship net present value. So we follow a borrower over the full relationship with the lender in our data, and we calculate the net present value. So this is all repayments minus the loan. And if it was ability and leniency were positively correlated, you would expect to see a positive slope, which is 0. So at least, again, this is suggestive, but you don't tend to see any effect of any correlation between ability. This is an important story because it's not because the leniency measure is in our head, right? In some sense, we're imposing this model on the advisors. It may just be reflecting ability. Okay, so finally, we want to show that different groups, demographic groups, are treated similarly. So we show that in each case, whether you look at male borrowers, female borrowers, young borrowers, older borrowers, getting a more lenient advisor, and this is a draw conditional on those effects I talk about, always leads in general to more take-up. You have positive slopes in each case. There's no negative. It's not that lenient guys behave one way with the other and another way with the other, because then the measure doesn't make sense. So no matter who you're seeing, if you're more lenient, the different groups you should be seeing. Okay, the slopes are a bit different, and that's fine, but they should be positive. That's the fact. It's always increasing, weekly increasing the probability of take-up. Okay, so now the results. So the first set of results are the change in credit scores is always the log, and this is the change in credit score relative to the quarter before the application. So t equal to -1 is the baseline. We're looking at the change in credit score in the quarter of the application, 1 quarter after the application, all the way to 1 year after the application. So you're tracking out the trajectory of the credit scores, and now we've instrumented, and hopefully you guys at least partially buy the instrument. Nobody ever fully buys the instrument, including us, but hopefully if you buy the instrument, then what we're going to show you are the causal effects if you buy the instrument. Okay, so the OLS, of course, has all the endogeneity bias I was talking about, and you get these estimates. And the IV estimates after the instrument are bigger, so there's this positive bias in the OLS, okay? And you can see that there's a hit right away, and then you can see a 10% drop by the end of it's a 10% change in the credit score, so a year out. Okay? This is the reputational hit we are talking about. Okay, on default, none of this is significant, so I'm not going to go out on a limb here. Okay, you tend to see positive estimates, so you tend to see suggestive evidence of, these are all IV estimates now, all of these IV estimates of problems later on, but these are not significant, so I'm not going to say anything on that. The number of CCJs, the CCJs are county court judgments. They are when the debt or collectors will file a case, and the court will say you have to pay, or you've been served a judgment. Why haven't you paid? So it's a measure of default as well, formalized default, and here you can start to see that default is increasing. So yes, so so these guys may get multiple CCJs. Most have zeros, but some guys will have 12, 13 CCJs, so they have been defaulting on different loans. They're borrowing and defaulting. On the cell phone bill, for instance, on the electricity bill, it could be loans from these guys, so that's what's happening. Okay. So most people have zeros or ones, mostly zeros, because it doesn't reach that situation, but some people are defaulting repeatedly. You can't do that forever because the market will shut you out, but obviously a year or two of this can happen. Okay. So mostly they'll disconnect your cell phone. If you run up a huge bill, the provider may go after you. You went overseas, roaming charges, and then you didn't pay or something, I don't know. 1. Yes, if on that particular case, yeah. You could go from 1 to 2 if you already defaulted on a credit card and now you defaulted on something else. And if the court learnt of this and passed a judgment, because the CCJ is actually recorded, a county record, court record. Okay. On credit, so we want to see what happens to their credit. So this is total credit, so short-term and long-term credit. You can see it's increasing. Okay. Most of the increase is because of the short-term credit. In fact, this is precisely the roughly the amount of 200 pounds which you borrowed from this guy. So basically, these guys borrowed, their credit expanded. They do more credit searches, but they're not actually adding after that to their credit that much. There's not that much credit expansion going on. And that's also kind of signaling this constraining that's happening from the market side. Okay, as you can see, when you look at the other credit, it's basically 0. It's all in the short-term credit, and it's all coming from the lender. Okay, searches. So you see evidence of more searches as time goes by. So these guys are searching more intensely. Okay, these are all IV, the causal effects if you buy the instrument. 4 additional searches on average per quarter by the time a year has gone out. So these people are approaching lenders, asking for credit. So this is what's being captured here. And some of this is short-term, not all of it is short-term. Some of it is also other long-term credit. So you're seeing no change in credit, but credit search. So this is what we take as evidence of the market tightening. These guys are being rationed. by the market. They borrowed, and the causal effect seems to be a progressive rationing by the market over time, okay, for this pool of average.
So it's possible that their own financial situation is deteriorating in the meantime, right?
It is possible. It is possible, but again, I don't know how to cause an effect. So there's a path dependency in this. If you're being rationed by the market, that means your only source of credit is expensive credit now. And that could also then contribute to the, so if you're not rationed by the market, maybe your financial situation would not have shaken this much. Now the question is, is the rationing by the market rational? To alliterate, right? Is the rationing rational?
So your coefficients could be overestimated.
Yes.
Because it might be picking up some of the
spillover from rationing.
some of the actual deterioration in.
It could be, I don't, so there'll be different stories. Somebody could say, if I had only gotten access to money then, I would be in a good situation now. I didn't have access to money, and therefore I had a van, it broke down, I couldn't repair it, I lost my job, I had to borrow, I'm in a mess now. I'm going to go bankrupt. So this path dependency, because you're not able to smooth consumption at critical points, is important. You pull your kid out of school.
The question is your ID taking care of it?
Should it take care of it? It doesn't. It's picking up the net effect of the loan, right? So the question is, can we tease out the trajectory independent of the borrowing from the trajectory after the borrowing? That's the question I'm asking. It's a good question. I don't think we do that. It's picking up the total effect.
I mean, I'm just wondering, if you go back and see, the IB being a local average, and that's who are we really talking about here? And so these are people who are, we're talking about people who maybe got lucky because they were
Or unlucky. No, in some sense, it seems lucky at the time of the loan, but data suggests.
Yes. Right, but in general, whose outcome, the take-up in this case, is affected by the leniency, by the instrument here.
Yes.
Right, so is that a different set of people in some sense?
So we cannot identify the compliers because the assumption is that they're randomly. So the assumption is once you condition on these cells, which we always do, it's the luck of the draw whether you get a random lenient guy or not. So we don't actually, within this, unlike many randomized controlled trials situations, we cannot actually identify the compliers. A good question, who are the compliers? But if there's a random subset of the borrowers, who are the compliers?
I'm not even actually interested in the issue of compliance. I'm just saying, an ID typically picks up, or by design picks up only those people whose behavior is affected by the.
Yes.
So in this case, are we really picking up only those people whose take-up is affected by whether or not they hit a lenient officer?
Yes.
So is that small group? So there are some people who would have got a loan anyway.
Right.
And there are others who would not have got a loan.
And some who would not have gotten otherwise and got it otherwise.
Right. So therefore, who can we generalize this result to? And these subsequent patterns that we are seeing, is that because we are sort of really talking about this group of people?
So I had a very nice graph. This is a very good question. If it is the case, it's a very stark step function of credit score. Below a certain credit score, you are never going to get it. Above a certain credit score, you're 100% sure. Then you're already talking of the guys on that threshold. However, it's not that stark. You'll be surprised. So there is a significant probability of not getting the loan even if you're at 530, 540, 550. That means that we are really picking up the distribution. It's a very good question. Yes. Sorry, I preempted you. Okay. All right. So the summary of the IV strategy is there's an immediate and permanent drop in credit score. There's an increase in short-term credit, and that's really driven by this lender's credit. And it's consistent with credit constraints. There's lower defaults initially, but higher defaults in the long run, especially significant for CCJs. And there's an increase in search for outside credit, but no increase in the level of outside credit. So borrowers are rationed by the non-short-term lenders and are in financial distress over time because you can see the default. So there are two measures of financial distress that we're picking up here. They're searching more for credit. Why do you do that? You're needing money and you're not being given credit. And on the other hand, you're also starting to show default patterns. So there's financial distress being picked up here. Okay, now the other approach, which is RD, and this is very local to the worst borrowers, the guys who are at the bottom at around 400, Below 400, the company doesn't approve loans, although you'll see it's fuzzy. Some people below 400 also get a loan, and some people many people above 400 don't get a loan. So it's not a clean treatment, 0-1. Therefore, it's a fuzzy RD. So we want to look at these people, partly because we have an instrument there, we have this threshold, and partly because we know that these people don't have a reputational issue. The market has concluded these people have a very bad reputation. So it doesn't matter, the reputation channel is shut down for these people. We could have looked at the leniency IV only for this pool. We could run the same strategy only for this distribution, but we did not do that because, well, we do that and we find very noisy estimates. So the power is very poor. Okay, so then we exploit a minimum credit score cutoff in a fuzzy RD design, and it's fuzzy, as I said, because the loan officers have some discretion. We assume, again, monotonic thing, and I'll show you the RD graphs. The RD graphs are very easy to show. Visually, RD is perhaps the most compelling of the new set of identification tools. Very clean, okay, very local but very clean. So here's the graph on take up, the first stage. You can see that not everybody below 400 is rejected, okay, and not everybody above 400 is accepted. Okay. So this is what, in fact, as I said, about 50-60% get approved, but not everybody. This is the question that the gentleman asked him. So you can see the jump. A very clear first stage. Okay, that nails the first stage. It's very significant. The regression, you can size it by local polynomials on both sides, and it's very clear. Okay, so the question is the manipulation of the credit score to push people over. This is the standard issue with RD. If you can manipulate the running variable, then it kind of invalidates the RD, because you want to argue that people kind of, at least partially by chance, fall on one side of the threshold or the other. And while there are these funny spikes, which we haven't fully understood in the credit score distribution of the applicants, there is no systematic difference in mass at the threshold. If you look at the histogram, so this is the Justin McCreary density test, it passes the test. Okay, so that's in the paper. Okay, so now you also want to show that other than the credit score, at the threshold, the other covariates are smooth. Otherwise, there's some kind of other sorting that's going on. So in RD design, you want to show that the only thing that causes people to be rejected or accepted is the running variable, the credit score. It's not because they're male, female, high income, low income. It should be very smooth over the threshold. So you're really doing an apples to apples comparison around the threshold. Okay, so that, and so if you look at age, gender, and marital status, you can see that around the threshold it's smooth. We fitted graphs, and you basically see 0 estimates, 0 point estimates for any breaks. Okay, so it's a nice experimental setup around 400. Okay. Now when you plot credit scores, this is the surprise, which we were expecting to see a similar story because we didn't have the reputational story when you first ran the regression. But when you, so this is credit score the quarter before, and it's also smooth. Okay, that's fine. It should be smooth. This is the credit score the quarter before. There should not be a difference in, when they came that quarter, they should look very alike the quarter before. They should be smooth. And unfortunately, quarter 0, quarter 1, quarter 2, quarter 4. All of these I'm flicking through very quickly, but these are standard RD graphs in the outcome variable. If we know that people on this side were less likely, significantly less likely to get the loan than people on this side. There was a break in the first stage. If that is, and that break was causing a difference in credit scores, in other words, if these people are hurt, the people who got the loan, you'd expect to see a drop here. You don't see a drop here. It's a flat 0 throughout. In other words, there seems to be a 0 causal effect for this subpopulation of borrowers from getting the loan, which is stark contrast to the other empirical approach where I showed you that there is a 10% drop after a year. This is t equal to 1, so 4. You can see there's no result here. It's a 0 result for this thing. Okay, so we have now these two. So the struggle for us had been to reconcile these two very different pieces of evidence. One suggesting there's a big credit score hit, and the other suggesting there's no credit score hit from the loan. Okay, so this is the regression analogs of the graphs, and this is the first stage. The first stage estimates look a bit different because we have different samples depending on how much they're, because these are different quarters out, so there's different samples. But you can see about 25%, the first stage. So the 25% discontinuous jump at 400 in the probability of getting a loan. Okay, and when you look at the scores, credit scores, change in credit scores, zeros, and fairly precise zeros actually throughout. Okay, nothing like the numbers you saw before, the minus 10% numbers, nothing like that. Okay, you can see there's not much happening in default. If anything, the point estimates are consistently negative. The defaults are low, so it's possible that they're actually taking the money to pay off something immediate, like a bill or something. The number of CCJs, sometimes minus, sometimes positive. Towards the end, you tend to see a slight increase, but again, insignificant, so I can't make any claims here. And the credit story is a bit similar to the others. There's increase in credit. It's mostly driven by the short-term credit. Nothing happening on the other credit. Okay, it's mostly the short-term credit that's driving the increase in credit. I wouldn't be too alarmed by these bouncing estimates. You can see the standard errors are rather large, so it's all within the same confidence bound. Credit searches, you don't actually see evidence of, it's a very noisy estimate. You can see the errors, but you don't see evidence, at least no evidence of more credit searches.
So they are not searching for credit, but they're getting no credit.
So the more credit they got is actually, that's the cumulative total, that's the loan they actually got. So it's not that every quarter they're getting additional credit, that is the credit expands by £200, to take an illustrative case, when they got the loan, and it stays like that, so it shows up persistently. Okay, they might be topping up or replacing it or something. Okay, so there's a zero effect on credit score for the lowest score group, and our interpretation of this, which is being now, there's a back and forth from feedback from reviewers, is there's a reputational cost of receiving a higher cost, a high cost loan that's already been incurred by this group. The additional bad signal does not move the posterior because the prior is bad and precise for this group. So, and we also find there's more short-term credit with no change in default or search behavior, so there's no evidence of rationing. They've been rationed out. There's no further rationing in some sense for these borrowers. And so we think that at least for some borrowers, taking up a high-cost loan is going to be triggering off this reputational cost, and this means there's a trade-off between immediate alleviation of credit constraint and suffering in the future. Okay, and the question is whether borrowers know this. As I said, it's not clear that the borrowers are tracking their credit scores like we are, because we got quarterly snapshots. Those borrowers may not be tracking. They may discover it, or some of them may discover it time. And even if they do, is this a trade-off rational people may want to make? We're going to be agnostic about whether people are rational or irrational about when they make this trade-off, but this is a trade-off we're seeing in the data. Okay, so wrap up. So using high cost credit affects future financial health. The effect is heterogeneous. It depends on the borrower's prior credit reputation. Those who had a very poor reputation to begin with are largely unaffected. Those who had the mid-range, it's 550 is still a pretty bad credit score, they seem to take a reputational hit. We know it's reputational, it happens immediately and persists. And it doesn't seem to be linked in a systematic way to the repayment burden of repayment. And the way it works is the market tightens around you. You are flagged, and then you are searching and being turned down. What does it mean to have more searches and not more credit? You're searching and being turned down is what we are seeing in the data. Okay? So what does it mean for regulation, which is probably the weakest bit of the paper because we haven't mapped this fully to policy. So if borrowers are rational, they will choose, some may choose to be credit constrained. If today's MU of consumption, value to consumption is high enough, they know there's a reputational hit, but I need it today, I could make the trade-off. It may be that consumers are not rational or they're unable to evaluate this trade-off correctly, so they may not know of this, or they may not be able to do the correct calculation. In that case, there could be some policy agenda here to fully understand how consumers evaluate this trade-off. Are they aware of it, and do they evaluate it correctly? And of course, this is also Mansour's, the paper I talked about with the credit issuers in the beginning, the JFE paper I mentioned, where he's looking at what happens to firms with a small shock to fundamentals, a credit downgrade, and that causes tightening around them and worsening situation. So this means the reputational channel could have a self-fulfilling, self-reinforcing effect. And that's distinct. You should be able to see conceptually distinct from the burden of repayment story. A tightening of the market, so if all else remained equal and you were able to borrow as you did before, many could escape, but because the market is tightening progressively around you, even though the burden is not great to begin with, that burden becomes onerous because the market has changed in response to the reputation. So this is the channel we think explains the story most parsimoniously. All right, thanks a lot for your attention, and feel free to ask me any questions. I did rush through it very fast, I always do, I'm sorry.
So one alternative explanation could be that, suppose you lose your job before you take up this loan. So the longer, and if the credit rating agencies know about your employment history, so the longer you've been unemployed, the more the hit to your credit score.
Possibly. Would you But we have my leaking here, so I mean,
That would be my mission, but so are you actually controlling for employment history, income and all these other factors?
So in the regressions, we haven't teased those out. We should probably. We did look at the migrants separately because the lender wanted us to look at the migrants. As I said, we didn't find dramatically different results for the migrants. They're roughly similar. And as soon as we start cutting the sample more, we start to get much noisier estimates.
I mean, do you know whether, like, do you control for whether they're salaried employees or self-employed?
in the
Or,
no, we should do that.
I mean, I don't know if it'll make a, because we assume random sorting once you condition on those cells. So in some sense, but it may be the effects are heterogeneous for in that dimension, employment versus non-employment, and it will be worth looking.
So just from the macro perspective, it's sort of weird. This is the correct data. Sure. So one thing that I was thinking is that typically my impression was that if there is a huge dispersion in wealth, then that will also reflect in the variability, how much they are paying back and so on. So one possibility is rather than the income stream, conditioning on the wealth level itself, although I'm not sure if data is available. So which actually relates to the other point that these consumers seem to be either extraordinarily wealthy or somehow they can say that I do not care about consumption spending at all, they do not have any precautionary savings. Going by the examples that you gave, they are borrowing money for conspicuous consumption.
So a washing machine breaking down is not particularly
Conspicuous. Maybe it's Christmas gifts, yes.
So
Even those are kind of expected.
So this is ideological. So Daniel is, oddly enough, despite being Esther and Sendel's student, is in the rational camp. So he has carefully tried to keep the paper away from behavioral stuff. I, on the other hand, Stefano and Matt Rabe and others, I think that it's very hard to explain behavior like this assuming rationality. I agree with you. There's something about this group. I mean, it could be a very bad draw, very high discount rates, but I don't think that fully explains. I mean, literally, you would want to just say 1 month I will just drink water, eat pasta, and somehow get rid of this interest rate thing, get rid of the loan, and I'll be better off. Exactly, that's exactly the point. So why you don't do that? What kind of self-control issues are at work? And these are developed societies. You're not people who are starved to death. So why you still see this is, so I think there's a behavioral story which we have clearly steered. I lost that battle with Daniel, and I think wisely because we don't have information on that, and the data setup is not allowing us to.
What is the proportion of the people who are in those three groups? If you could give.
When you say three groups,
You had those three lines.
yes, I think 10, 24, and so 10% are strategic defaulters, the smart set, smart, unscrupulous set, borrow with no intention of repaying, right? If you wanted to default, the optimal time to default will be right after the loan. You don't want to pay back anything. You may default, but that may be accidental because some circumstances got worse halfway through. But you already paid back interest and stuff, so and you're going to take a hit when you default on your credit score. So it's 10% is strategic default, 24% is partial, and the rest is full payment.
Okay, so one more final question for you. So I saw this in this movie that earlier, that the number of times that you apply for US citizenship or something, the more number of times you get rejected, that already increases the probability of the next rejection. Can something like that, is it work here that the number of times one person gets rejected already increases the conditional of that, the next probability?
It's public though? Is that information public?
It has to be public, right? That's the only way the rest of the market can observe. Reputation has to be public. It doesn't work privately.
So I don't know, along with the credit score or something that suppose the agencies which are giving out credit, they come to know about the number of times one particular guy has been rejected.
Oh, the credit search thing. I don't know. They will not reveal to us the algorithms. They also, the lender, we asked the lender to talk to the credit agency as to why they are flagging their mid-range borrowers so brutally. And we wanted to be on that conversation, but the credit agency said the algorithms are proprietary and being updated on a real-time basis, whatever that means, and so we never had that conversation. So all I can say is the credit file is extraordinarily detailed. There's 700 variables on the credit file, and many have data. So we have this incredible treasure trove but only for all the applicants to this firm. We don't have, so again, if there's a very select pool of people that go to this firm, which is very distinct, and I don't have any reason to believe that's true, except that this firm locates in the high migrant area. So maybe it's not capturing your typical English experience, it's capturing kind of a London, which is London's high migration zone.
But actually, I mean, the data you showed us actually shows that being rejected actually is not a major factor that's affecting your score, right? One is you're bouncing back, but the people who are getting these high cost loans, who are taking up the loans, they are the ones whose credit history is the credit scores are affected the most. So being rejected is actually a better thing than getting.
So Daniel and I have also tried to figure out this, and this we don't have a full answer for why the very act of applying is not costing you. In that case, both should be hit, right? It's the fact you went to this guy, that's telling me something is wrong with your situation. You're in some downward trajectory. I am going to flag you and let the market know, because that's my job as a credit rating agency. You are now a riskier prospect.
And the fact that a high cost borrower, a high cost lender is rejecting you means that you should be the worst prospect possible, right?
True, true. So I don't know how to process the thing, and it's not. We always assume that the credit rating models are actually best and optimized, but it's not clear to me that that is indeed the case. So we've sent the paper to the agency as well. We haven't gotten any feedback from them.
Some possibility.
Yeah, also there were another very interesting diagram where I showed that a guy with 350 credit score might get something, someone with 450 might not. So the causal explanation will say that it's full leniency.
No, so this was, well, if you assume it's leniency, but it could be something very unique to that person's thing. So he has 350, but he shows that he's an employment letter from a firm. Okay, then he's going to rebuild his credit score. That's obvious. That's good evidence that he's going to rebuild his credit score. Those kinds of things may happen. So, all right, thanks a lot, guys.